Welcome back. Hope you're having a good morning. Well, Mayuresh Joshi, Director, Research at Marketsmith India, joins us on the show. Hi, Mayuresh. Good morning. Good to see you in. Mayuresh, I wanted to ask you about BSE. The numbers look quite good. You have a bit of an issue with regard to the STT hike that's come about. But what's your view? The stock is not cheap, but it's got, revenue growth. It's got earnings momentum as well. And it's appeared to be the market favorite, though it trades at a sharp premium in comparison to NSE. Your view on the stock?
Morning, Nigel. So I think the numbers have been surprisingly very good. There has been a strong revenue uptake. In fact, it's the highest quarterly revenue that has got recorded. Obviously, I think in terms of the margin performance, the transaction revenues have seen an increase over a 9-month period. The Star MF platform has also done well. And therefore, I think the kind of apprehensions that one really had in terms of volume going down with the number of expiry days actually getting reduced. I think that has really not created a dent in terms of reported numbers. Obviously, the STT increase will have some amount of say as we go through a transitory phase. But generally, I think looking at the kind of additions that BSE has probably done, I think the transaction revenues might continue on a strong uptick as more additions happen, both on the member side as well as the net user in terms of unique client codes. And therefore, you're absolutely right. Even if valuations are on the higher side, as a theme, I think it might continue doing well. From a rating ranking perspective, I think it's got one of the best rating and rankings as we map on our internals in Marketsmith India. And therefore, I think the momentum can very well continue.
Amber also reported very strong numbers, Mayuresh. What is the view on Amber, particularly post Q3, and compare it with the other EMS companies where the numbers are out?
Morning, Rima. So again, I think strong set that Amber has reported. Obviously, the tailwind that acts for EMS as a space in general is the higher allocation in terms of the 40,000 crore that have been earmarked in the budget. Obviously, I think the expectations in terms of more orders coming the way of Amber or a Dixon as we head into the next few quarters, and a model transition change, which is apparent in terms of their books. The ODM component is starting to inch higher as we speak, which will obviously have a say in terms of better margins as we head into FY27. The expectations in terms of more clients coming their way across different product categories also helps them to a large extent. And therefore, if you map out the entire space, whether it's Amber, Dixon, Sirma SGS, which also has a different kind of contribution coming into energy, probably being the largest contributor, or an Apple on tech as an example as well. I think the valuations for all of them are still sky high as we speak. But are there enough business opportunities in terms of order wins, market size gains? Absolutely, yes. Do they trade at a premium compared to what they were, compared to their own standard deviations? They are obviously at a premium compared to the market, but in their own standard deviations average, I think they are fairly priced as we speak. However, I think from a risk reward perspective, I think these stocks are only for those growth or momentum chasing investors who probably believe that valuations might just take some element of a sidetrack, and the market should probably look at the growth dynamics rather than the value perspective. So I think these set of stocks are for growth investors.
Okay, well, thanks very much, Mayuresh, for that.
Mayuresh, did you hear the conversation with Pearl Global? And what do you think is going to be the impact on Indian textilers?
I think you will see a sentimental profit booking, as Prashant rightly mentioned. And Bangladesh has always been competitive. So if you probably look at the construct in terms of our exports, we dominate in a few areas, while Bangladesh dominates in most areas as we speak. China also has a huge say when it comes to bed sheets and bed pillows in particular. Having said that, I think the integrated players who have probably got the entire value chain with them, right from yarn till fabric, might feel the pinch a little lesser. And because of their integrated facilities, the expectations in terms of control of costs and having those operating efficiencies play out might be a tad bit better compared to the rest of the pack. And therefore, I think integrated players like a KPR Mill, as an example, Vardhaman Textiles, where the rating rankings look fine comparable to a lot of other textile players as we speak, might be in a tad bit of a better position. In fact, even into-account industries, though the rating rankings are a tad bit poor because of the pressure that we've probably seen because of tariff impositions, the new capacities and the greenfield expansions that they've announced in the US itself, the starting or commencement of their pillow facility, I think that will abet the kind of tariff impositions and competitive pressures as well. But it is still going to take time, because the entire aspect is that once the trade deal is done, US is out of the way. EU will still take time, but I think integrated players are a tad bit better placed than the others.
But is this just a sentiment impact, or do you think it's going to cap the kind of growth rates the street was expecting? Many of these stocks, Gokuldas, for instance, is about 20% away from its all-time high levels. KPR is about 30% away from its 52-week high. So is this sentiment, or is it going to change the earnings profile on account of increased competition from Bangladesh?
No, in my opinion, I don't think that the earnings are going to get hit substantially. So it might be a sentimental hit at first. And these players will adapt and adapt themselves in terms of competitive pressures. And therefore, I think our thesis is that integrated players should be able to probably assume both the cost impact as well as the competitive intensity impact from a pricing perspective and fare better than the others.
Thank you, Mayuresh, for joining in. We'll